For a new investor, one of the most tempting things is to invest in a very high yield or big dividend stock. And what I wanted to talk about in this video is how exactly these work and why they're quite dangerous, and I would actually recommend staying away from them. And I'm going to discuss the common pitfalls of investing in these types of stocks, and I'm also going to go over the two reasons why these stocks often don't make the returns they're advertising. And, for the purpose of this video, I would say a yield of 7% or more is going to be what I would consider a big dividend. And these sort of stocks are commonly associated with something known as a real estate investment trust. And you'll see it abbreviated as REIT. And what this is a pool of investor money that's used to invest in real estate. And typically it's used to invest in rental properties and commercial properties. And the idea is that the profit can be paid out to the investors in the form of a big dividend. And the goal of the fund is just to generate this profit or dividend for the investors without actually growing the fund itself. And the idea is that pooling money makes it easier for the average investor to invest in very high-end real estate. And I don't mean necessarily luxury real estate, but I mean like commercial real estate, like an office building or something like that, that costs millions and millions of dollars. Theoretically, a real estate investment trust can be used to finance such a project, which the profits from the rental can then be paid back to the investors. I mean, that sounds good on paper, but there's two big problems with this. One problem is that a single bad deal can tie up the investor money and lead to a drop or a halt in dividend. If let's say they're in the real estate investment trust used a large amount of its funding to build a building, and then there was a problem with the construction. Either they built it on, a sinkhole, or the water's not good, or something's wrong with the project and it runs over budget. I mean, that can ruin the real estate investment trust. They're not going to be able to pay out a profit. They might be operating at a loss. And that could cut the dividend for a year or two until they get it back. And it could even lose money. And at that point, the real estate investment trust is just going to tank. No one wants to keep their money in something that they think it's a money pit, and people are going to sell out at a loss and just cut their losses and move on. So my recommendation is to not be involved in one of these trusts or don't invest just passively, like, oh, I like this company, they pay 8%, I'm going to buy into that. That's just a bad deal. What you want to do is instead be actively involved in it. That would be something you'd probably have to have a lot of money to do, and be knowledgeable in real estate investing and actually participate in the management company or know what's going on with their deals. And that's not something for the typical investor for sure. And the other problem with these companies or trusts is that there's no growth. And let's say it's a company that's paying out that kind of dividend, not a real estate investment trust. If they're paying out this huge dividend, that means they're dipping into revenue that could be used to drive future growth. And as a result, the dividend typically doesn't increase. And what the company is trying to do is trying to maintain their earnings in the face of increasing competition with no investment. It's just very difficult to do. It doesn't seem to last. So no company is able to pay out 7% plus without at least spending some money on the company itself to try to grow a business, because the competitors are investing in their business, and if the company you're invested in is not, they're only going to be able to maintain that dividend for so long until they get overtaken. And as a kind of an example of an opposite of this is like a blue chip dividend company, which might only pay like 2 to 4%. They're going to increase that yield every year, though, by a couple percentage points. They'll go from like 40 cents to 41 cents, or 73 cents to 75 cents, or whatever they're jumping. But over a period of years, that really adds up. They might double the dividend over a period of 15 years. So it's something to think about. And those are just really the two main problems with the real estate investment trust. Again, I would stay away from them unless you really are familiar with the particular company. I hope this video is helpful.